You guys, the SEC just dropped was basically the rulebook for the future of crypto in America. And let me tell you, this is not some boring PDF you can ignore. This thing is gonna decide which projects survive and which one gets sent straight to the crypto graveyard. And by the end of this video, you will know two things. First, where the actual opportunities are hiding behind the rules. Second, whether the coins you're holding are safe or cooked. So yeah, if you don't want to end up back holding something the SEC caught illegal, stick with me. Let's break it down. First, quick question. Who is really running the crypto in US? Most people just go, the government? And yeah, it's probably true. Or Congress. Yep, they have been cracking out bills left and right. Or the Fed. They're not even technically the government, but every time they breathe, the market freaks out. Raising rates, cut rates, it's chaos. But here is the real deal. Congress sets a vision. The Fed sets a mood. And the SEC, they write the actual rulebook we all have to play by. Think of it like a video game. Congress is a game designer. The Fed controls the weather, and the SEC is the one handing you the instruction manual with a big fat play by these rules or you're banned. So here's what happened. This September, the SEC dropped its new regulatory agenda. Basically their to-do list for the next 2 years. And out of all the boring items, 5 directly target crypto. And trust me, they are not random. Together, they cover the whole pipeline. Token creation, custody, exchanges, brokers, even market makers. And translation, they want to fold crypto into the security system. And the way they're doing it, these 5 rules I have split into 2 categories to help you understand better. First, core rules, the big pillars. Second, support rules, the guardrails. Alright, first, let's get into the core rules. Number 1, Rule 38, token issuance. This is a big one. It basically says if you're gonna issue a token, you need to register. End of story. So, those days of white paper plus hype plus a Telegram group means new coin? Yeah, it's over. And meme coins, shitcoins, they are on life support. And serious projects, they will have to do disclosures like IPOs. So yeah, it is going to slow things down, sure, but the survivors will be more legit. Kinda like cleaning out your closet. What is left actually has value. Number 2, Rule 49, exchanges. If Rule 38 is about creating new coins, Rule 49 is about trading them. And the SEC is like, hey Coinbase, hey Uniswap, congrats, you are both securities exchanges now. Go get a license. DeFi used to be like, we're just cool, man, nothing to see here. But SEC says, cute, still an exchange, register. So if this passes, DeFi is in for a reality check. Imagine telling a bunch of degens they need SEC paperwork before yield farming. Then let's talk about support rules. Rule 46, custody. Okay, so this one is about protecting your funds. Basically, no more trust me bro from exchanges. Now you have segregated accounts, audits, and bankruptcy protection. No more FTX-style magic tricks where billions just vanish. But it also means extra costs. And you know these costs roll downhill straight to us. But the upside? Institutions finally get comfy. Because, let's be real, BlackRock isn't parking billions in crypto until custody is bulletproof. Rule 48, brokers. If you want to be a crypto broker, sorry, no more empty shell companies with a Gmail account. Now you will need actual net capital, segregated client funds, and transparent books. In other words, little guys out, big players in. Okay, case in point, Forex.com. Yeah, the same one you see in stock trading. They're owned by StoneX, a giant listed on Nasdaq. And they're rolling out crypto trading under full regulation. Soon, it will log in and see, trade Bitcoin, ETH, Doge, stocks, gold, oil, whatever you want, just in one app. That is DeFi convenience, but with Wall Street muscle. Rule 51, market makers. Traditional finance market makers, tons of capital, fancy algos, years of experience. DeFi market makers, you, me, and some guy named Chad with $200 in Uniswap pool. So the SEC says, nah, if you're providing liquidity, you are a dealer, which means license, compliance, paperwork. So in the short term, DeFi liquidity shrinks. But in the long term, fewer rug pulls, smoother markets. So when's all this going down? Okay, the SEC's plan is staged. 2026, issuance, custody, brokers. 2027, exchanges, and market makers. So first, they target coin launches, custody, and brokers. Then, they move in on DeFi and exchanges. That means the next 2 years are gonna be messy. Small projects, wiped out. Tiny brokers, gone. Amateur LPs, good luck. Meanwhile, the big dogs, like banks, funds, traditional brokers, step in and take over. It's basically a full industry reset. Okay, here's bottom line. The SEC isn't killing crypto. They're domesticating it. In the short term, painful. Some projects won't survive. DeFi won't feel the same. But in the long term, institutions flood in, markets stabilize, and the next bull run might just be the biggest yet. So, are you excited for a clear, Wall Street-friendly crypto market? Or, like me, kinda nostalgic for the degen Wild West days? Alright, let me know what you think in comment section. And please don't forget to leave a like and subscribe. I will see you guys in my next video. Bye!